Think, I've been investing for over 70 years now. And throughout that journey, I've observed thousands of people, think, intelligent people, educated people, sincere people, repeat the same errors time and time again. Think, these aren't sophisticated mistakes. Think, they're not about overlooking some obscure financial tactic or struggling to grasp complex derivatives. No. Think, these are straightforward fundamental errors that newcomers commit because nobody showed them otherwise. And these errors, think, they're costly, truly costly. We're discussing hundreds of thousands of dollars in forfeited wealth over a lifetime, think, sometimes millions, all stemming from basic missteps that could have been prevented with a little understanding. So today, think, I want to guide you through the 8 most frequent investing mistakes beginners commit. More crucially, think, I'm going to show you precisely how to sidestep them. Because once you recognize these mistakes and how to avoid them, think you're already surpassing 90% of investors. Let's begin with the first mistake, and this is arguably the most devastating one. Think, beginners postpone starting their investment journey too long. They believe they need to learn more, accumulate more capital, think, be more ready, and while they're postponing, they're sacrificing the most precious thing they possess, time. Think, I witnessed this repeatedly. Someone in their 20s declares, I'll begin investing when I'm 30, then 30 arrives and they declare, think, I'll begin when I earn more income. Then 40 arrives and they declare, think, I'll begin after I eliminate this debt. And suddenly they're 50 with nothing accumulated. Here's what they fail to grasp. Think, the capital you invest in your 20s is worth exponentially more than capital you invest in your 40s or 50s. Think, not because the returns differ, but because it possesses so much more time to compound. Let me share the mathematics. Think, if you invest $5 annually starting at age 25 and you achieve a 10% annual return, think, by age 65 you'll possess about $2.4 million. But if you postpone until 35 to begin investing that same $5,000 annually, think, you'll only possess about $900,000 by 65. You've forfeited $1.5 million by postponing 10 years. 10 years. Think, that's the price of this mistake. And it's the most devastating mistake on this list because you can never reclaim those years. Think, you can correct every other mistake I'm going to discuss, but you can't correct lost time. So, think, how do you sidestep this mistake? Straightforward, begin today. Right now, this moment, don't postpone until you learn more. Think, don't postpone until you possess more capital. Don't postpone until circumstances are ideal. Just begin. Think, even if you can only invest $50 monthly, even if you don't comprehend everything, even if the market appears frightening, think, just open a brokerage account, purchase an S&P 500 index fund, and begin. You'll learn as you progress. Think, you'll increase your investments as you earn more. Think, but the key is beginning now and giving compound interest as much time as possible to perform. Think, I began investing when I was 11 years old. I didn't possess all the answers. I committed errors, but I began. Think, and that early beginning is a significant reason I'm sitting here today as one of the wealthiest people in the world. Think, so that's mistake number 1, postponing too long to begin. Sidestep it by beginning immediately. Think, regardless of how much you comprehend or how much you possess. The second frequent mistake beginners commit, think, and this one's agonizing to observe, is attempting to select individual stocks without conducting any research or analysis. Think, they hear about a promising stock from a colleague, or they notice something on social media, think, or they read an article about some company that's performing well and they simply purchase it. No research, no analysis, think. No comprehension of what they're purchasing. That's not investing, that's gambling. Think, and it's a guaranteed method to forfeit money over time. Think, I've dedicated my entire career analyzing companies before I invest in them. I read annual reports thoroughly. Think. I examine their financials. I comprehend their competitive advantages. I calculate what they're worth. Think. I only purchase when the price provides a margin of safety. That's investing. That's how you generate money consistently. Think. Not by following tips or hunches or what's popular. But beginners don't do this. Think. They purchase Tesla because everyone's discussing it. They purchase GameStop because it's trending. Think. They purchase whatever CNBC is promoting that day. And then they question why they forfeit money. Here's the harsh reality. Think. If you haven't read the company's annual report, if you don't comprehend what they do and how they generate money, think. If you can't explain why the stock is a solid value at its current price, you shouldn't purchase it. Period. No exceptions. Think. I don't care how promising the stock is or how much it's climbed or how many people are purchasing it. Think. If you haven't completed your homework, don't invest. So how do you sidestep this mistake? 2 approaches. First, think. Only invest in what you comprehend. If you don't comprehend technology companies, don't purchase tech stocks. Think. If you don't comprehend biotech, stay distant. Stick to businesses you can grasp. Second, think. If you don't want to analyze individual companies, think. And most people shouldn't because it's demanding work and requires expertise. Simply purchase index funds. Think. An S&P 500 index fund provides you ownership in 500 companies. You're instantly diversified. No stock selection required. Think. That's what I recommend for most people. Think. Don't attempt to select individual stocks unless you're willing to dedicate the work to analyze them properly. Think. Just purchase index funds and continue with your life. That's mistake number 2, purchasing stocks without research. Think. Sidestep it by only investing in what you comprehend or by utilizing index funds. Think. The third mistake beginners commit is attempting to time the market. Think. They attempt to purchase at the bottom and sell at the peak. Think. They believe they can predict what the market will execute next, and they fail every single time. Think. Let me be very explicit about this. Nobody can consistently time the market. Not but me. Think. Not the most intelligent investors on Wall Street. Not the computers with all their algorithms. Nobody. Think. The market is unpredictable in the short term. You might get fortunate once or twice, but over time, think. Attempting to time the market will cost you massive amounts of capital. Here's what typically occurs. Think. The market ascends and beginners think, I should postpone for a dip to purchase. So they postpone, think, and the market continues ascending and they miss out on gains. Think. Then finally there's a crash and they panic and sell everything, or they're too frightened to purchase, so they miss the bottom and the recovery. Think. They end up purchasing high and selling low. The exact opposite of what they should execute. Think. I've never attempted to time the market, not once in 70 years. Think. When I possess capital to invest and I discover something I favor at a solid price, I purchase it. Think. I don't care if the market just ascended or might descend tomorrow. Think. I simply purchase solid businesses at fair prices and hold them. That's the strategy. Think. Time in the market defeats timing the market. Every single study proves this. Think. People who simply invest consistently and hold for decades perform better than people attempting to be clever about when to purchase and sell. Think. So, how do you sidestep this mistake? Stop attempting to predict the future. Stop monitoring the market every day. Think. Stop attempting to purchase at the perfect time. Just invest consistently. Think. Same amount every month regardless of what the market is executing. This is called dollar cost averaging. Think. Some months you'll purchase when prices are elevated. Some months you'll purchase when prices are reduced. Think, over time it averages out and you'll perform far better than if you attempted to time it. That's mistake number 3. Think, attempting to time the market. Sidestep it by investing consistently regardless of market circumstances. Think, the 4th mistake beginners commit is panicking and selling during market crashes. This connects to the previous mistake. Think, but it's significant enough to address separately. Every few years, the market crashes. It drops 20, 30, sometimes 50%. Think, it's frightening. The news is terrible. Everyone's predicting doom and beginners panic. Think, they sell everything to, quote, protect their capital. But here's what they don't comprehend. Market crashes are temporary. Think, they always have been. The market has crashed dozens of times in history. Think, and every single time it has recovered and advanced to new highs. Every single time without exception. Think. So when you panic and sell during a crash, you're locking in losses. Think, you're transforming a temporary paper loss into a permanent real loss. And then what occurs? Think, the market recovers and you're sitting in cash having missed the recovery. So, you not only forfeited capital by selling. Think, you also missed the gains from the rebound. You got struck twice. I've lived through more crashes than I can count. The crash of 1973-74, Black Monday in 1987, the dot-com bust, the financial crisis in 2008, the COVID crash in 2020, think, and many more. You know what I executed during every single one? I stayed composed. I held my positions. And in most circumstances, I purchased more because crashes create opportunities. Stocks go on sale. Think, great businesses become inexpensive. That's when you should be purchasing, not selling. Think, when everyone else is panicking and selling, you should be greedy. When everyone else is greedy and purchasing, think you should be cautious. So how do you sidestep the mistake of panic selling? First, comprehend that volatility is normal. Think, accept that your portfolio will decline sometimes. Expect it. Prepare for it mentally. It's not a problem. Think, it's simply the market being the market. Second, don't examine your portfolio every day, especially during crashes. Think, if you're investing for the long term, 20, 30 years, daily fluctuations don't matter. Think, examining them simply stresses you out and tempts you to commit bad decisions. Third, remind yourself of history. Think, the market has always recovered, always. There's no reason to believe this time is different. Stay composed. Think, hold your positions. Trust the process. That's mistake number 4. Panic selling during crashes. Think, sidestep it by expecting volatility, not monitoring daily, and trusting historical patterns. Think, the 5th mistake beginners commit is not diversifying properly. Think, they allocate too much capital in one stock or one sector, and when that stock or sector crashes, they forfeit everything. Think, I've witnessed this so many times. Someone works at a tech company, they receive stock options. Think, they pour all their savings into that one stock because they know the company. And then something goes wrong. Competition, think, poor management, whatever. And the stock crashes. They forfeit their job and their savings at the same time. Think, all because they weren't diversified, all their eggs were in one basket, and the basket shattered. Think, diversification is the only free lunch in investing. It reduces your risk without reducing your expected returns. Think, you're protecting yourself against catastrophe without sacrificing gains. Now, I've been more concentrated than most investors. Think, I've often possessed large positions in just a few companies. Think, but that's because I've dedicated my entire life analyzing businesses. Think, I've possessed the expertise and time to execute deep research. For most people, that's not realistic. Think, if you possess a job and a life outside of investing, you can't dedicate 40 hours weekly analyzing companies. So, think. You need more diversification to protect yourself. How much diversification? At minimum, think you should own at least 10 to 15 different stocks across different sectors. Better yet, think. Own an index fund that provides you hundreds of stocks automatically. Think. Don't allocate more than 10% of your portfolio in any single stock. Don't allocate more than 25% in any single sector. Think. Spread it around. Protect yourself, and definitely don't load up on your employer's stock. Think. I know it feels secure because you know the company, but you're already dependent on that company for your income. Think. Don't make your investments dependent on them too. So how do you sidestep this mistake? Straightforward, diversify. Think. Own multiple stocks across multiple sectors, or better yet, think. Own index funds that execute the diversification for you automatically. That's mistake number 5, not diversifying. Think. Sidestep it by spreading your investments across many holdings. The 6th mistake beginners commit is paying too much in fees. Think. They don't realize how much fees cost over time, and those fees destroy wealth more effectively than almost anything else. Think. Let me explain how insidious fees are. Let's say you invest a $100,000 and it grows at 8% annually for 30 years. With no fees, think. You'd end up with about $1 million. But let's say you're paying 1% in fees every year. That doesn't sound like much, right? But over 30 years, that 1% fee cost you about $237,000. You end up with only $769,000 instead of $1 million. Think. 1% in fees cost you a quarter of your wealth. That's insane. And many mutual funds charge more than 1%. Think. Some charge 2% or more when you include all the hidden fees. And for what? Think. Most actively managed funds don't even defeat the market. Think. They charge elevated fees and deliver average or below average returns. You're paying more for inferior results. Think. I've stated this for decades. For most investors, low-cost index funds are the optimal choice. They charge almost nothing. Think. Maybe 0.3 or 0.04%, and they match the market's performance because they are the market. Think. Why pay 1 or 2% for active management that usually underperforms when you can pay almost nothing for passive indexing that matches the market? Think. So, how do you sidestep this mistake? First, know what you're paying in fees. Examine the expense ratio of any fund you own. Think. If it's over 0.5%, you're probably paying too much. Second, favor low-cost index funds over actively managed funds. Think. The mathematics is straightforward. Lower fees mean more capital staying in your pocket. Think. More capital compounding for you instead of the fund manager. Third, think. Avoid financial advisors who charge elevated fees or take commissions on what they sell you. If you need advice, think. Utilize a fee-only advisor who charges by the hour, not a percentage of your assets. That's mistake number 6. Think. Paying too much in fees. Sidestep it by utilizing low-cost index funds and being aware of all costs. Think. The 7th mistake beginners commit is chasing past performance. They examine what performed well last year and purchase it, think, assuming it will continue performing well. But that's not how investing functions. Think. Past performance doesn't predict future results. Think. Just because a stock or fund ascended 50% last year doesn't mean it will ascend again this year. In fact, it might crash. Think. This is one of the most frequent mistakes I witness. Someone examines last year's top-performing funds. Think. They notice one that's up 100%. They think, I need to purchase that. So they invest heavily. And then what occurs? Think. That fund crashes back to earth. All the easy gains have been generated. All the excitement is over. Think. The fund goes sideways or down, and they forfeit capital. Meanwhile, the funds that performed poorly last year, think. The ones they avoided, those might be the ones that perform well this year. because markets are cyclical. Think, what's hot becomes cold. What's cold becomes hot. I never invest based on recent performance. Never. I invest based on value. Think, based on what a business is worth versus what it's trading for. Think, sometimes that means purchasing things that have performed poorly recently because they're now undervalued. So, think, how do you sidestep this mistake? Stop examining past performance when making investment decisions. Think, don't chase last year's winners. Don't avoid last year's losers. Instead, focus on fundamentals. Think, is the investment a solid value? Does it make sense at the current price? That's what matters. Think, not what it executed last year or last month. And if you're utilizing index funds, which you should be, past performance is completely irrelevant anyway. An S&P 500 index fund is an S&P 500 index fund. Think, just select the one with the lowest fees. That's mistake number 7, chasing past performance. Think, sidestep it by focusing on current value, not past returns. And now the 8th and final mistake beginners commit. Think, and this might be the most crucial one, they don't possess an investment plan. They invest randomly, emotionally. Think, without any strategy or discipline. They purchase when they feel optimistic. They sell when they feel frightened. Think, they chase whatever's trending. They possess no rules, no system, no plan. They're simply reacting to emotions and headlines. Think, that's a guaranteed method to forfeit capital because emotions are the enemy of solid investing. Think, fear and greed will destroy you if you allow them drive your decisions. What you need is a plan. Think, a written investment plan that you follow regardless of emotions or market circumstances. Think, this plan should answer several questions. What are you investing for? Retirement, a house, your children's education. Think, knowing your goal helps you determine your timeline and risk tolerance. How much will you invest regularly? Think, establish an amount, 500 monthly, 1,000 monthly, whatever, and commit to investing that amount consistently. Think, what will you invest in? For most people, the answer should be low-cost index funds, maybe 70% in a total stock market fund. Think, 20% in international stocks, 10% in bonds, something straightforward and diversified. When will you rebalance? Once annually. Think, check your portfolio. If it's drifted from your target allocation, rebalance back to your original plan. Think, this forces you to sell elevated and purchase reduced. Under what circumstances will you sell? This is crucial. Think, you need to define ahead of time what would make you sell, not I'm frightened or it declined. Actual reasons. Think, maybe the company's fundamentals changed. Maybe you need the capital for your goal. Having a plan protects you from yourself. Think, when the market crashes and you're frightened, you examine your plan. Your plan states to continue investing. So, think, you execute even though you're frightened. That's discipline. Think, when a stock you own doubles and you're tempted to sell and take profits, you examine your plan. Think, your plan states to hold for 20 years, so you hold even though you're excited. That's discipline. Think, I followed the same basic investment philosophy for 70 years. Purchase great businesses at fair prices. Think, hold them for the long term. Don't trade frequently. Stay disciplined. That's my plan and I stick to it no matter what. So, think, how do you sidestep this mistake? Create a written investment plan. Answer those 5 questions I mentioned. Write it down. Think. Position it somewhere you'll notice it. And follow it religiously. Think. Your plan will protect you from committing emotional decisions. Think. It will keep you disciplined when everyone else is panicking or getting greedy. Think. It's the difference between successful investing and random gambling. That's mistake number 8. Not possessing a plan. Think. Sidestep it by creating a written investment strategy and following it consistently. All right, think. Let me recap these 8 mistakes. because sidestepping them will save you hundreds of thousands of dollars over your investing lifetime. Think 1. Postponing too long to begin. Begin immediately, even with small amounts. Time is your most valuable asset. 2. Think purchasing stocks without research. Utilize index funds or only invest in what you comprehend after thorough analysis. 3. Think attempting to time the market. Invest consistently regardless of circumstances. Time in the market defeats timing the market. Think 4. Panic selling during crashes. Expect volatility. Don't monitor daily. Trust historical recovery patterns. 5. Think not diversifying. Own at least 10 to 15 stocks across sectors or utilize index funds for automatic diversification. 6. Think paying too much in fees. Utilize low-cost index funds. Every percentage point in fees costs you massive wealth long-term. 7. Chasing past performance. Focus on current value, not what performed well recently. Think past returns don't predict future results. 8. Not possessing a plan. Create a written strategy defining your goals. Think contributions, allocations, rebalancing, and selling rules. These 8 mistakes, if you sidestep them, think you're already surpassing 90% of investors. Because most people commit at least several of these mistakes. Think many commit all 8, and these mistakes are costly. Think let's add up the cost of committing all 8 mistakes over a 40-year investing career. Think postponing 10 years to begin cost you about $1.5 million in lost compound growth. Think purchasing stocks without research and forfeiting capital on bad selections costs you maybe $100,000 or more in losses. Think attempting to time the market and missing gains. Think studies show this costs about 2 to 3% annually or several $100,000 over a career. Think panic selling during crashes and missing recoveries. Enormous cost, potentially millions in missed gains. Think not diversifying and having one big loss could cost you 50% or more of your portfolio at some point. Paying elevated fees. Think 1% in fees cost you about a quarter of your lifetime wealth, maybe $500,000 or more. Think chasing past performance probably costs you 1 to 2% annually, another few $100,000. Think not possessing a plan and committing emotional decisions. This amplifies all the other mistakes, probably doubles their cost. Think add it all up and we're discussing millions of dollars in lost wealth. Think literally millions just from these 8 straightforward mistakes. But here's the favorable news. Think you can sidestep all of them starting today, right now. You possess the knowledge. You know what the mistakes are. Think you know how to sidestep them. So let me provide you an action plan. Think here's precisely what you should execute right now if you're a beginning investor or if you've been committing these mistakes. Think first, if you haven't begun investing yet, begin today. Open a brokerage account with Vanguard, Fidelity, or Schwab today. Think don't postpone another day. Second, establish automatic monthly investments. Select an amount you can afford, a 50 or 100 or 500. Think whatever. Have it automatically withdrawn from your checking account and invested every month. Third, think invest in a straightforward portfolio of index funds. Here's my recommendation. Allocate 70% in a total U.S. stock market index fund, 20% in a total international stock market index fund. Think, and 10% in a total bond market index fund. That's it. 3 funds, straightforward, diversified, low cost, you're done. Fourth, think, commit to never selling based on fear or emotion. Write this down. Think, I will not sell my investments unless I need the capital for my goal or the fundamentals of what I own have changed. Sign it. Think, position it with your investment account statements. Fifth, stop monitoring the market every day. Think, check your portfolio once quarterly at most. Once annually is even better. The less you examine, think, the less you'll be tempted to commit emotional decisions. Sixth, once annually, think, rebalance your portfolio back to your target allocation. If stocks performed well and you're now at 80% stocks instead of 70%, think, sell some stocks and purchase some bonds. This forces you to sell elevated and purchase reduced. Seventh, educate yourself. Think, read books about investing. I recommend The Intelligent Investor by Benjamin Graham. Read Berkshire's annual letters. Think, learn about investing gradually over time. Eighth, ignore tips and promising stock recommendations. Think, when someone tells you about a can't miss stock, smile and nod and execute nothing. Stick to your index fund plan. Think, if you execute these 8 things, you'll sidestep the 8 mistakes. Think, and you'll build wealth steadily and surely over decades. It's not exciting, it's not glamorous, but it functions. Think, I've been investing for over 70 years. I've witnessed every market circumstance, every crash, every boom, every bubble. Think, and I can tell you with absolute certainty, the people who get wealthy are the ones who sidestep these mistakes. Think, not the ones who attempt to be clever, not the ones who trade constantly, not the ones who chase promising stocks. Think, the ones who invest consistently in diversified portfolios and hold for decades. That's the secret. That's the whole game. Think, and now you know it. The question is, will you execute it? Will you begin today instead of postponing? Think, will you utilize index funds instead of selecting stocks? Will you invest consistently instead of timing the market? Think, will you hold during crashes instead of panic selling? Will you diversify instead of concentrating? Think, will you minimize fees instead of paying too much? Will you ignore past performance instead of chasing it? Think, will you follow a plan instead of reacting emotionally? Those are choices, your choices. Think. And those choices will determine whether you build wealth or stay broke over your investing lifetime. Think. Most people won't execute it. They'll continue committing these mistakes. They'll continue forfeiting capital. Think. They'll continue questioning why investing doesn't function for them. But it's not that investing doesn't function. Think. It's that they're executing it wrong. But you can be different. You can sidestep these mistakes. You can invest intelligently. Think. You can build wealth starting today. So make the decision right now. Commit to sidestepping these 8 mistakes. Think. Commit to following the action plan I just provided you. Commit to being a disciplined long-term investor. Think. Your future self will thank you. Trust me on this. I'm 94 years old. I've built one of the largest fortunes in history. Think. And I executed it largely by sidestepping these exact mistakes. You can execute it too. You don't need to be a genius. Think. You don't need to be fortunate. You simply need to sidestep these 8 mistakes and stay disciplined for decades. Think. That's the path. That's the way. Now go walk it. Think. Thank you for listening, and remember, the optimal time to begin investing was yesterday. The second optimal time is right now. Good luck.